Hello, everyone. This is Marshall Gittler, head of investment research here at FXPRIMUS. And today I'm going to be discussing the upcoming central bank meetings that we've got in store. We've got three big ones coming up in the next 2 weeks. The ECB on March 10th. That's next Thursday. The Bank of Japan the following Tuesday, March 15th. And the Fed on the day after that, on Wednesday, March 16th. Also, we've got the Bank of Canada and the Reserve Bank of New Zealand in there too, so it's a lot of central bank activity, but I'm not going to be talking about those two. And as we all know, the markets are being totally dominated now by the central banks, so these really are the key events coming up over the next 2 weeks for the FX markets. So what can we expect from the meetings? Well, first, I'd like to discuss what the general world conditions are that all the central banks are facing. The main things to notice are as follows. One, growth in most countries is stagnant at best. It's slowing at worst in many countries. In particular, growth in the emerging markets is slowing, and that's very bad. These countries were responsible for a lot of the demand in the developed world. As a result of slowing growth everywhere, global trade is falling, and that's very bad for export-dependent countries. For the central banks, they're going to particularly notice that as growth slows, inflation is still well below target everywhere. Even though inflation rates are rising in some places, they're still well below what the central banks would like. And finally, financial markets are quite volatile, although fortunately they're not as volatile as they were back in January. Now, I'd like to focus for a moment on the fourth point here, sluggish inflation, which is of course very important for central banks. It's true that inflation has picked up in many countries, as I mentioned, but it's still well below central banks' official targets in most of them. We can see here that in the US, the dark blue line, the inflation rate is moving back towards target. But in the EU, with the yellow line, and Japan, the light blue line, these countries are almost in deflation. So it's hard to see how those two in particular are going to hit their targets, how those two central banks are going to hit their targets without further action. That's why I think we might see some more activity from the central banks. And here's a point we should consider, how do lower interest rates help an economy? In theory, you reduce the price of money, you should increase the demand for money, and bank lending should rise. But it's just not happening. This graph shows the year-on-year change in bank lending in the G4. And you can see that while bank lending has been rising in the US, the yellow line in this case, in the Eurozone, Japan, and the UK, it's pretty stagnant, and it's still well below where it was before the financial crash. That's because companies don't borrow just because money's cheap. They borrow it because they think they can invest that money profitably. Why should they bother building a new factory if they don't think they can make money with it? This is the other problem the central banks face. Lowering interest rates really hasn't had the effect that it's supposed to. It hasn't worked in one of the main ways it's supposed to because of the nature of this recession. So if lowering interest rates doesn't encourage borrowing, what does it do? What effect does it have? Well, it weakens the exchange rate. That's one way that central banks can help their economies out, by lowering the exchange rate and, in theory, improving the country's relative position in international trade. But of course, a country's exchange rate will only fall if other countries don't cut their interest rates at the same time. If everyone lowers their interest rates at the same time, then relative interest rates remain the same and nobody wins. They just all wind up in the same situation, but with everybody worse off. And in fact, for the lower inflation, the lower interest rates have started to have the opposite effect to what everyone wanted. Now that they've got negative interest rates, it's started to really shake people's faith in banks. This is a graph of bank stocks relative to their home markets. You can see how bank stocks have dramatically underperformed the overall stock markets in Europe, Japan, and the US. That's because investors are worrying about negative interest rates eating into banks' profits. Now, this is the real irony of the situation. If negative interest rates eat into banks' profits, the banks might actually have to start charging more for loans, not less. So it may be that the interest rate tool is no longer as effective as it was for central banks. So now let's get back to central banks and let's discuss the central bank meetings in the order in which they occur. First, the ECB. Now, the ECB is the one where the expectations are the highest. At their last meeting, ECB President Draghi gave a big hint that they'd increase their market assistance at this meeting. He said that Eurozone inflation dynamics were weaker than expected, and it may be, quote, necessary to review and possibly reconsider our monetary policy stance at our next meeting in early March, when the new staff macroeconomic projections become available, which will also cover the year 2018. Now, this point about the staff forecast is really quite significant. The forecasts that they have now only go out to 2017. The next meeting, they'll go out, as he said, to 2018. These forecasts are very important for the ECB. As you can see from these two graphs, the graph on the left shows that they're forecasting that growth will recover over the next couple of years, and the graph on the right shows that they're forecasting inflation will move back towards their target over the next 2 years. But if they revise down their forecast for this year and next year, which seems almost guaranteed, and if their forecast for 2018 shows that they still don't think inflation is going to be back to target by then they'll really have to take some further action. They'll have no excuse for doing nothing. As you can see here from this blue line, inflation expectations haven't been affected at all by the ECB's actions. The blue line here is the market's forecast for inflation over the starting 5 years from now. What will the inflation rate be for the following 5 years? And as you can see, this line has been unaffected by the enactment of zero interest rates. It's been unaffected by negative interest rates. It's been a little bit affected by quantitative easing, but still expectations for 5-year inflation 5 years from now is still much lower than it was when they started all this loosening. And one of the main reasons for this, as you can see, is the oil price, which is the yellow line. Inflation expectations are not following monetary policy, they're following the oil price. And indeed, if you look at the last couple of dots closely, the oil price has started to turn up again, but inflation hasn't. Inflation expectations become completely uncoupled. So this is quite worrisome for them, because what they really don't want is for people to get in a deflationary mindset. They don't want people to start thinking that inflation will never come back. Now, to tell the truth, we know and they know that they really can't do anything. If you look at this graph, this shows the short-term interest rates in Japan, the yellow line, and Japanese inflation, the blue line. The Bank of Japan has kept its short-term rates at 50 basis points or less for the last 20 years. 20 years, and it's had no effect. They're still struggling with deflation. That rise you see at the end there to 4% is because they hiked consumption tax, not because of any inflation. So I'm not sure that central bankers really do have the tools to create inflation right now, but they can't admit it. No central banker can stand up and say, well, we're really powerless to do anything about this. The former Bank of Japan governor, Shirokawa, effectively said this, and he was kicked out of his job, basically, to make way for Governor Kuroda, who promised to do more. So the ECB, if inflation isn't recovering, the ECB will have to do more, even if they think that those steps won't make any difference. That's because of the role confidence plays in the markets. They have to appear confident even when they're not. So from my point of view, the question isn't whether they'll do anything. The question is, what are they going to do? And more importantly, whether it will be enough to impress the markets. So what did they do in December? At their last meeting, they lowered the deposit rate by 10 basis points to negative 30 basis points. They extended the duration of their bond purchases by 6 months, and they made some other small adjustments to that. But Mr. Draghi had built up expectations so high ahead of the event that this small tinkering at the margins was a big disappointment. And what happened after that was Eurodollar jumped 4 cents in one day. This is exactly what they don't want to happen. They don't want to see the currency strengthen. So the key point this time is they know they'll have to do something really big or else the market will once again be disappointed. And the second disappointment after such strong suggestions in January would be really, really disappointing for the market. It has sent the euro up sharply and stock markets down sharply, and they can't risk that. Financial conditions in the Eurozone have already been tightening over the last few months, whereas in the US they're actually looser, despite the fact that the Fed hiked rates in December. So what can they do? They need to make a big impression on the market. Just changing one thing probably wouldn't be enough. So that's why I expect them to reveal several new measures. Among these, I'd expect to see a further cut in the deposit rate. I think it's quite possible. Up to now, the cuts have been 10 basis points each. I think if they really want to impress people, they're going to go by more than 10 basis points, although that would be really unusual. The introduction of a tiered deposit structure. The problem, as I said, they've got a problem with negative interest rates because it costs the banks money. Banks have to pay, I mean, that's what a negative interest rates are. Banks have to pay money to deposit money with the central bank. So I think they might put in a tiered deposit structure like they did in Japan, so it doesn't cost the banks as much money. I think they'll also increase the monthly bond purchases and once again extend the duration of the bond purchase program again, as they did back in December. And I think they'll make some more other small adjustments, which I won't go into. Now, the question for us is not whether these measures will be effective in boosting economic activity or raising inflation. That's not what matters for the FX market. The issue for the FX market is whether these will be enough to boost confidence. I think they will be enough to demonstrate that to the market that the ECB is seriously worried about the downside risks of inflation to the economy. It's going to take, as Mr. Draghi said on another subject, quote, whatever steps are necessary. I think it will show that they're willing to do whatever is necessary to fight deflation. That should probably boost Eurozone stocks and weaken the euro, as happened when they cut rates first time around into negative territory. This is what happened when they first announced, for example, the quantitative easing program. You can see how the Eurodollar fell and the stock market, Eurodollars fell 3 cents and stocks rose 1.6%. I'm not sure we could get that big a move this time, but I think we could see another substantial move. Now, moving on to the Bank of Japan. The Bank of Japan meeting is the following week. It's a lot harder to predict what they're going to do at that meeting. On the one hand, their problem is inflation isn't going anywhere after, as I said, 20 years of almost zero interest rates. The blue line here is the national CPI. You can see how it went up a bit when they raised the value-added tax, but it's back down almost to zero inflation. They've even invented a new measure of inflation, the yellow line, one that excludes fresh foods, energy, and the effect of the tax hikes in order to make it easier for them to meet their inflation goals. But even that measure has stopped rising, as you can see from the graph here. To make matters worse, inflation expectations are falling in Japan again. The graph on the left shows the percentage of people who expect inflation to be higher next year. That's been falling recently. And the graph on the right shows, again, the market's expectations for inflation for the 5 years starting 5 years from now. That's back to zero. So the market basically expects that over the next 10 years, there will be no inflation. That's really bad. So there is substantial reason for the Bank of Japan to ease further. But remember this graph of the bank stocks that I showed you before. Look at the yellow line, which is Japan. You can see how Japanese bank stocks collapsed when they initiated the negative interest rate. They're down. Bank stocks fell about 20% relative to the market. That's because people are really worried about the impact for stocks of negative interest rates for Japanese banks. Furthermore, the Bank of Japan board only voted 5-4 in favor of going to negative rates. That's a very close vote. And it doesn't, such a close vote on such a major change in policy doesn't inspire much confidence in such a radical move. Now, there are 4 people who voted against negative interest rates. One of them, Ms. Shirai, will be leaving the Bank of Japan board on March 31st. And another one, Mr. Ishida, will be leaving on June 29th because they all serve 5-year terms. And both these people were appointed before Mr. Abe came into office. If I were a Bank of Japan Governor Kuroda, I'd wait until at least Ms. Shirai left the board and probably until Mr. Ishida left as well, and Mr. Abe had a chance to appoint new members who were more sympathetic to his point of view before taking any action again, rather than risk having the vote go against me or at least another 5-4 vote. So I think they'll wait at least until April, until after Ms. Shirai leaves, and probably until July before changing rates, unless something major happens. That would suggest to me that the yen is likely to strengthen after the upcoming Bank of Japan meeting, because I think there will be some people expecting them to take action ahead at this meeting, and there will be some disappointment in the market that they don't, and I think the yen will strengthen somewhat as a result. After that, it's a lot to do with the general global risk environment. I still believe that Japanese investors have more money to put offshore, and those capital flows are likely to weaken the yen further over time. But a lot depends on the global risk environment. Now, finally, moving on to the Fed. The day after the Bank of Japan meets, the Fed announces its decisions. I don't think anyone expects them to raise rates at this meeting. Nonetheless, I think the market is underestimating the likelihood of another rate rise by the Fed this year. This graph shows the FOMC's forecast for the Fed funds rate over time, taken from the materials that they publish every quarter. That's the yellow line. Compared with the market expectations for Fed funds, the blue line as derived from the Fed funds futures. As you can see, there's a huge gap here. The FOMC is assuming at least 3 more rate hikes this year, while the market's only pricing in a 66% chance of even 1 more rate hike this year. But does the committee really need to hold off as much as the market thinks? Look, the Fed has a dual mandate. They are required to aim for price stability, which they define as a 2% rise in the core personal consumption expenditure, and full employment, which they estimate to be a 4.9% employment rate. As you can see, they're pretty close to reaching both those targets. In fact, the unemployment rate is at more or less at what they estimate to be full employment, and the inflation rate is moving up towards their target. There's no question about it. So then, why didn't they move again in January? Why did they delay? Why are they putting it off? They explain then that they are, quote, closely monitoring global economic and financial developments and assessing their implications for the labor market and inflation and for the balance of risks to the outlook, unquote. Now, note that they said, it's very important, global economic and financial developments, unquote, not just domestic economic and financial developments. So apparently a lot depends on whether global growth recovers and markets around the world stabilize. Of course, mostly in the US, but they're also interested in what happens everywhere. Now, if we look at what's the volatility of various markets, this graph shows the volatility of the US stock market, that's the VIX index, the dark blue line, the volatility of the US Treasury market, the gray line, the volatility of G7 foreign exchange, the yellow line, and the volatility of the oil market, the light blue line. You can see that volatility is still pretty high, but it's come down in the last couple of weeks. I think if that continues, if volatility continues to decline and the market stabilizes somewhat, I think they still want to hike rates further, and I think they will hike rates again. So what should we look at this next meeting where they're probably not going to hike rates? What should we look at the meeting? I think the most important thing to look at is the dot plot. This is the dot plot from the December FOMC meeting. Each dot on this graph represents the forecast of a member of the Federal Open Market Committee, their forecast for the Fed funds rate at the end of each year. You can see from this graph the distribution of forecasts for each year. This is where I got the average weighted forecast that I used for the FOMC estimates of interest rates that I used in the earlier graph. Now, I think if the committee is still forecasting at least two rate hikes this year, whereas the market is even pricing in one, I think the market will have to adjust its rate expectations upwards. That's likely to strengthen the dollar. So that, I think, is the key thing we should be looking for at the Fed's meeting. If, on the other hand, the committee capitulates to the market's view and forecasts only one rate hike this year, then I think the dollar will weaken. What's my expectation? Which do I think will happen? Personally, I think the Fed members, FOMC members, are very slow to change their view. They're very reluctant to make a big change. I think that they will forecast more rate hikes this year. I think the market will be surprised on this account, and I expect the dollar to strengthen after the FOMC meeting. In any event, Fed officials constantly say that they have no preset schedule for rate hikes, but that rather it all depends on the data. Well, the data has been gradually improving recently. As you can see from this graph of economic surprises, the blue line shows the overall the surprise in all the economic indicators. The yellow line is just the surprise within the inflation indicators. Both of them are turning up, have been turning up recently. So I think the market accordingly has started to reprice the possibility of Fed tightening further again this year. Markets now pricing in a 66% chance of one more rate hike this year. That's up from just 64% earlier this week and only 11% less than a month ago. So we should certainly watch tomorrow's U.S. unemployment data closely. Another good non-farm payrolls figure would certainly help to make the case for another rate hike. And by the way, that's what I'm expecting the NFP figure tomorrow to show as well. So just to sum up, I think the ECB is going to move further and the yen, the euro weaken further as a result. I think the Bank of Japan is likely to stand pat. That may cause the yen to strengthen. I think the Fed will surprise people with a relatively hawkish stance, and I expect the dollar to strengthen after that meeting. And with that, I'd like to throw the floor open for any questions. How do I get there?
Interesting.
Great question. Why do people buy negative interest rate bonds? My first job in the financial industry was as a bond market analyst. And I must say, I'm really glad that I'm not doing that anymore because it's really a bizarre market, a bizarro market, if any of you know Bizarro Land from Superman. Why would people buy a financial instrument where you are guaranteed to lose money? The point is, I guess, where are you going to put $100 million if you have $100 million? You may be guaranteed to lose 10 basis points over the next 10 years in US Treasury bonds, well, not in Japanese government bonds, but you could lose 10% if you put them in stocks. So a small guaranteed loss, I guess, is better than a possible large loss. I think that's the only thing. Plus, there's what's called in economic theory, the greater fool in economic thought, the greater fool theory. Sometimes people buy things not because they think it's a good investment, but because they think someone else will think it's a good investment at an even better price. They think I'm foolish to buy this, but somebody else is going to be even a bigger fool than me. And in this case, you almost guaranteed a bigger fool. The bigger fool is the central bank. You can buy the bond at a negative interest rate and sell it at an even more negative interest rate to the central bank. That's why. Oh, I'm sorry, I didn't see that the question up there. How is the U.S. bucking the global? How is the U.S. bucking the global trend for inflation? Yeah, that's a very good question. Yeah, I think it comes down to two things as far as I know. First off, U.S. housing is a big part of the U.S. Consumer Price Index, and U.S. house prices have rebounded sharply. I know this because I own a house in Phoenix, Arizona, and at one point the price of my house was down 50% from what I bought it at. But now it's worth more than what I bought it at. It's doing very well. And rents have gone up as well. I'm renting my house out to someone. And I think that's probably one of the main things. Secondly, healthcare costs in America, which, as you may know, are out of this world. Healthcare costs have also been rising. So I think it's due to really domestic issues that the U.S. has, not any of the global trends in inflation. Flipping houses. Well, yeah. I don't know. I've held my house for more than 10 years. It's paid off. I'm just running out. Yeah, I think the what have I read about? I'm not sure about the U.S. housing market, but I think as long as interest rates stay very low, the housing market will stay, and the job market stays robust. I think house prices will be supported. They have gone up very much. As I said, my house is worth now more than it was when I bought it, and I bought it during the housing boom, so prices have risen a lot. But there are two things that really shape house prices: interest rates and the job market, and both of those are doing well. So I don't think the market's going to crash anytime soon. Now, are Fed decisions mainly oriented to drive expectations, or is it really about dealing with supply and demand? Yeah, that's a good question. It's very interesting to hear what Fed members, people on the FOMC say relative to what people who are not on the FOMC say. We've recently been hearing some very interesting comments from former Fed governor, former Fed chairman Greenspan, and former Bank of England governor Melvin King, who are, and Mr. Bernanke as well, former Chairman Bernanke. They seem to be less enthusiastic about the current measures than people on the committee. I personally think that a lot of it is to drive expectations. I think a lot of it is just an act to shore up confidence, because it's quite clear that they've hit the point of diminishing returns. They even hit the inverted point where cutting interest rates further, it hurts confidence in the banks, but they have to do something. They can't just throw up their hands and say we're hopeless. Really, I think fiscal, I think the G20 was right. Fiscal policy is what's needed now, not monetary policy. But politicians are even more feckless and hopeless than the central bankers. So the central bankers still have the power to act, and they have to. Final question, do you think hawkish Fed will cause the stock market to drop again? Stock markets and currencies often correlated. Now, e.g. the Japanese yen and the euro. Now, actually, this is a very interesting point. I'd just like to talk for a second about why is the yen so closely correlated with the Japanese stock market? That's because the Japanese investors own a huge amount of overseas assets. I think the largest overseas asset position in the world. When conditions are good in Japan, they become very risk-seeking. So they are happy to hold these positions unhedged. When things are when conditions in Japan are tighter, when the stock market goes down, when they don't have as much of a cushion in their P&L, they become more risk sensitive and they hedge their overseas positions. That's why the yen tends to strengthen when the Tokyo stock market goes down, because it's Japanese investors hedging their overseas assets to reduce their risk level overall. It really has nothing to do with capital flows. I can send you some research on this very point. Now, as for the hawkish Fed causing the stock market to drop, to be honest, I don't think it will, because to me, the Fed tightening is a vote of confidence in the U.S. economy. And I think they're doing it slowly enough, and gradually enough, and with enough, soothing words that people will take it as a vote of confidence. There's the point that they're making all the time is that they're not tightening policy, they're normalizing policy. Zero interest rates are unusual. I mean, I've got this book at home, A History of Interest Rates. It goes back to Mesopotamia, like when Og and Ur were lending each other seeds to plant in Mesopotamia. This is the first time in human history that we have had interest rates this low. It's not normal. So they're not tightening policy. They're just trying to get it back more into normal. 1% interest rates are still very low. So I think that's put it in that context, I think that gradual Fed tightening is a vote of confidence in the U.S. economy and should not be taken as a negative for the stock market. And with that, I'd like to sign off here. And you can stay up to date with the latest market news, with videos, special reports, and more on your favorite currencies by visiting our website, fxprimus.com/education. So the team at FXPRIMUS look forward to welcoming you on board. And thank you very much for attending this webinar.